Okay, so I wanted to talk a little bit about sFRAX. This is the latest product that's come out of Frax Finance. It was released last week, and it is a staking vault that allows you to put your Frax in, and it earns a reward rate over time. This reward rate is pretty much set to trend towards the Federal Reserve's IORB, but there's no guarantee of that, and it has a maximum yield of 10%. So there's two major events that occurred within the past year that were the huge catalyst for the creation of Frax V3, which we're seeing the deployment of now. The first catalyst was Luna, obviously, where you had several tens of billions of dollars of paper losses and capital losses, and it really showed the world that algo stablecoins are not going to work at scale. There's no way that you could take an algo stablecoin with zero collateral all the way up to billions of dollars of backing and not have some depegging event in the future. People are always going to figure out a way to depeg it, and once confidence is lost, it's going straight to zero. And that's what we saw in Luna. Additionally, with these algo stablecoins, the market's really smart. It sniffs out anytime there's any sort of like under collateralization or illiquidity in them, and people just try to be the first ones out. It's a prisoner's game where if everybody stays in, then it's 3-3, but if anybody leaves, then everybody loses, right? And it's better to be the first one out the gate than be the person who's like sticking around and getting stuck with whatever's left over, which is sometimes nothing, as in the case of Luna. This last week, we saw the collapse of a real estate-backed stablecoin called Tangible, and Tangible had used 60% of their portfolio to go out and buy properties around the world. Most of them were domiciled and located in the United Kingdom, and they had a 30% capital buffer, which was made up of protocol-owned liquidity that they thought would protect them, but it didn't. And within a day, the DAI reserves that were backing and liquid of the stablecoin were drained. I believe that's about $12 million or $13 million worth of DAI. And then after that, it was just free fall within the market. People wanted out of the stablecoin as fast as possible, and it fell to 50 cents. And now the company has to try to issue baskets of the reserve assets, or they have to go out and they need to sell those properties to try to recover some funds and recollateralize their system. So algo stablecoins and illiquid stablecoins don't work. Stablecoins only have liquidity issues typically, right? When we look at the USDC collapse, again, the primary issue there was that the bank was closed for the weekend. USDC wasn't able to process withdrawals. People thought that Silicon Valley Bank was going to get shut down, and that $3 billion worth of USDC's market cap was going to get stuck there for months, if not years, as the bankruptcy people had to figure it out, or an injection of money needed to come from somewhere else. And that spooked the market. That's what caused USDC to drop to 92 cents. And again, it just shows and highlights that if there's any questions around the liquidity of stablecoin and the solvency, it's gonna trend towards whatever people think that is, what that collateralization ratio is going to be. In the case of Tangible, it was about 50 cents, and in the case of Luna, it was zero, since there was nothing back in there. And in the case of Frax right now, if Frax didn't have any locked liquidity, it has a 91% collateralization ratio. So were steps taken in, I believe, March of this year, where a vote was pushed through the DAO to raise the collateralization ratio up to 100%. That passed, and now protocol profits are being used to raise the collateralization ratio. Based on my last discussion with Kit, this was about $500,000 a month. That's $6 million a year, and right now there's a $6 million collateral gap. So it's going to take a while, and the faster we can close the collateral gap, the quicker we can get back to using those funds to buy back and either redistribute or burn FxETH. Okay, so that's point number one, is that if there's an issue about insolvency or liquidity of the stablecoin, the market is always going to find it. It's going to punish you, and that we found through Luna. Now, the second issue that came up, which also is tied into Frax V3, is that interest rates have spiked. And over the course of last year, interest rates have gone from, well, on the long end, I mean, they're trading down in like the 1%, right? And now they're trading up towards 5%. Just the fastest rate rise ever in recorded history, I think, one of them, if not the fastest. And then nobody was really prepared for it. Everybody thought that rates were going lower for longer, and the speed at which we moved up in interest rates has just been shocking for the market. And it's also tied into the collapse of the crypto markets as well too. So now rates are at 5%, and that changes a lot of questions about how investors deploy capital. Because, why keep money in USDC or USDP, which is yielding 0, when you could move it to something that's actually yielding like 5%? It's not a hard question, and that's why we've seen USDC market cap decline by about 60% this year. Frax's market cap has declined by about 80%, down from 2 billion to 600,000, right, or 2.5 billion to 600 million. DAI has collapsed from a peak of 9 billion, and they're down to 3 billion now, I want to say. So everybody's come down, and it's really having an effect. The interest rate question has been literally the driving narrative for most all of crypto, right? Because when we talk about yields for ETH, or we talk about RWAs coming online, we're really just talking about like, how can we capture that 5% risk-free rate that everybody's so desperate to get for? Like, where can we get any money to flow back into the crypto ecosystem? And so this led to where we are today with Frax V3. And Frax V3 is the culmination of a strategy of two things. One is to close the collateralization ratio back to 100%. And then the second one is to increase, work to bring off-chain yields to the DAO somehow. And that is done through sFRAX and FinRes PBC. So earlier this year in March, we voted, I believe it was March, maybe it was June. A couple of months ago, we voted on FinRes PBC being added as the first RWA partner for Frax, and that vote passed successfully. And now FinRes, which is a public benefit corporation whose one mission is to earn yield for Frax, is now operating and is now taking deposits. The company, which is a public benefit corporation, doesn't charge any fees other than what it needs to sustain itself. It's not a for-profit enterprise like what you see at MakerDAO, and its sole mission is to support FrxDAO. And it's also run by members of the Frax core dev team. And so what FinRes is going to do is it's going to essentially take loans from the FrxDAO, which will give it USDC and USDP and maybe other assets too that it has on the books, but for now it's just those two assets. It will then swap those assets out through Circle and through Paxos for cash, and it will invest that cash into a variety of short duration assets. These are T-bills, additionally overnight repos, FMA account deposits, and then what's the last one? Oh yeah, money market funds. And so it's going to use a mixture of those to earn a yield that is close to what the federal funds rate, or federal IORB rate, interest on reserve balances. And it's going to use that to pass that income back to the FrxDAO. Now, the FrxDAO will then use that to bolster its balance sheet and support the peg. And what's interesting about this is that when you use the services like sFRAX, you're getting a reward in Frax, but there's no guarantee about the rates, for one, and the reward is just provided through the creation of new Frax. It's not tied to any off-chain product. There's no expectation that FinRes is going to do anything with the funds that it takes. FinRes just goes out and executes a strategy on behalf of the FrxDAO, and then returns the funds. So there could be a point where FinRes is not able to meet its obligations, and the sFRAX depositors may get a lower yield than what short-term treasury rates are. It really just depends. I mean, who knows what's going to happen here. For now, though, FinRez is going to go out and execute this strategy. They've been able to deliver a yield that is pretty decent. In the first week, 50,000 FrxETH was deposited into the reward contract. That has led to inflows of $40 million of FrxETH that I checked this morning, and a reward rate of 6.8%, which is pretty awesome. So this is meant to compete with MakerDAO, who has a similar product with SDAI, and MakerDAO actually had a similar product, but their reward rate had a different mechanism where it would start at 10% and then it would linearly go down as more capital came in, but it would not go back up again. For FrxETH though, if people pulled out of the vaults, and let's say that 40 million goes down to 20 million, that reward rate can go back up. So there's significant differences. The reward rate can tend towards zero. So if too much money comes in, comparatively to the amount of rewards which have been deposited for the week, the reward rate pretty much can go to zero. Because let's say if $500 million came in tomorrow and there's only 50,000 of rewards to support it, then that's not much yield, actually. The closest analogy of how sFRAX works is to sFRAXETH. And that's interesting because sFRAXETH has this system where they take ETH, they go out, they stake it on behalf of the people who've given them ETH. It's essentially a loan, right? They then use the ETH to try to get the most amount of rewards as they can in the safest manner and pass those back to the token holders through the sFRAXETH contract. Frax also has the power of its curve incentives that it can use, and it uses those to power incentives for the curve LP. And so it's the same for sFRAX. sFRAX is similar to the sFRAXETH vault, and then for the curve LP, instead of having a FrxETH LP, now we have the FraxUSDC and FraxUSDP base pools, which are getting a very nice 7% yield right now. So very interesting to see how this system is being replicated across the multitude of Frax assets that are out there now. I really do think that this is a game changer for Frax, and I'm looking forward to see how it develops over the next few weeks. I hope you guys enjoyed this video. It's a nice, beautiful autumn day in New York City, and we will see you again next time on Flywheel.